Hello, everybody. This is Drew Fristow, the 2020 president of the Fredericksburg Area Association of Realtors. And today we have with us
Scott Hine from Assurance Financial.
And as you see, that is not Maria, who is the EVP of FABA. They are graciously letting us use their Zoom right now. So thank you, FABA. But topic at hand. Scott, in the real estate world, I know from the realtor side, we are hearing a lot of things about the lending side of real estate kind of being a little crazy right now. So I thought I'd give you the floor and let you kind of fill us all in on what's happening.
Well, crazy may be the biggest understatement of the year so far. Chaos is a word I've been using a lot lately, but things are definitely changing. And they're changing rapidly, most of it just since last Friday. I'm going to share my screen here for a minute, and I don't want to get too technical on this, but I think it'd be good for us to just kind of take a look at kind of how we got to where we are, because up until about last Friday, as I said, it was crazy, and then it turned chaotic. But I've got a chart up here, the NBS market, the mortgage-backed securities market. And normally that's what drives mortgage rates. Pretty much 95% of the time, that's what the industry follows. I always tell people it's Wall Street that moves mortgage rates, not banks or lenders. But a couple of things on here. I've drawn a few lines just to kind of help us. But if you look back here, January 20th, that was when the first coronavirus case hit in the United States. So we had been talking about it up till then. It wasn't here, it was somewhere else. And so it wasn't a big deal yet in our minds, but you can kind of see that the mortgage-backed security started to trend up from there. And we started to see a lot of activity. Things started to get busy because rates were getting better. When the mortgage-backed securities go up, yields and rates come down as a result of that. Housing was doing well. I mean, February was just jam-packed. It was kind of crazy in a good way. It was steadily climbing there. And then you see here around the 21st of February, that's when the stock market really started its collapse. That's when things became very real here at home. And just a real quick snapshot of the Dow, you kind of see right here, we hit that cliff. Stocks, they were up and down, just bubbling along. You see this quick rise in the mortgage-backed securities. That creates our first problem. There's really kind of five things. This is going to be a real high-level overview. I'm not an economist by any stretch, but just kind of let us see where we are. But we were already doing good volume, and then all of a sudden, mortgage-backed securities went up, rates dropped precipitously, refi volume picked up tremendously, and volume became our first problem. Now, normally volume's a good thing, but when you increase your volume that much, it sort of sets the stage for some problems. Little things like just timelines of doing things. You're paying overtime to get all that through. It's just a higher cost of doing loans. So while the volume is a good thing, it opened the door for some problems there. We, in the first quarter, have done nearly double the volume as all of last year, or at least locked in. So I've been using that analogy of the snake swallowing the pig or the elephant. That's kind of what was happening right there. So, that's February 21st up until, first week of March or so there, you see a rapid, and so it's crazy. So you see this little band here. This is what the normal mortgage-backed security markets look like. That's normal trading. Obviously, this isn't normal trading. You don't have to be an economist to see. And so there was a couple weeks there where it was just swings like we've never seen in any given day. I mean, so one of the things that this run-up caused that was also problematic was servicing runoff. So Fannie and Freddie, for instance, they buy loans, but they don't service them. Your lenders collect the payments and process and everything, and they get a fee for that. They pay for that privilege. So we as a lender, we keep a portion of our loans or the servicing of them. Well, you pay to do that. Usually your break-even period is about 3 years. Well, when you have rapid runoff, all of a sudden loans that you've got in your servicing portfolio, they fall out of that servicing portfolio. So even though a refi seems like a good thing, it can mean a loss of revenue, especially if you've paid for that, if you haven't hit your break-even period. So that started the bleeding. Then when we got to this chaos right here, now it's full-on pandemic crisis mode, you know, with coronavirus. And what's it going to do to the stock market going from here? Are we going to go into recession? Are we going to go into a depression? What's the job market going to look like? What are foreclosures going to look like? You know, 2008 seems like a long time ago, but then again, it seems like just yesterday for those of us who've been in business. So what are home values going to be? So now in the midst of all of this chaos, when lenders are just doing everything they can do to get loans through the system, they're having to assess what's the risk and then what do we want to do here. That really set us up for where the problem comes in. So right here, you see where this rapid run up here, that's when the Fed stepped in and flooded the market with money. And basically what happened is they blew up the hedge. So when mortgage lenders lock in a rate, they put a hedge in place. Usually it's just a short against the market. So in you know, a normal market like this, it works fine. If rates go up, then when they sell it, they get the premium pricing. If rates go down, they've got their hedge to cover against it. So that's kind of what they're doing when they lock it. Well, the Fed came in here and kind of an unintended consequence blew up the hedge. So all of a sudden, lenders started bleeding money by the tens of millions. Here's just one article headline. I won't show the thing, but did the Fed just accidentally trigger a housing market crash? That's the kind of stuff we're dealing with. You know, headline or sub headline: by flooding the market with money, the Federal Reserve just accidentally pushed mortgage bankers to the brink of bankruptcy. I'm not trying to panic everybody, but the reality is they did some major damage there unwillingly. So to the tune of tens of millions of dollars, lenders were bleeding money. And that all really started Thursday and Friday of last week. And so that's where the chaos ensues. So normally, most lenders are pretty close to each other. You know, Fannie and Freddie, I always use them. If we think of mortgage lending as the wild, wild west, Fannie and Freddie are the sheriff in town. Well, they're not following Fannie and Freddie anymore. It's kind of every lender for themselves. You're seeing things just kind of going every which way. If they couldn't assess the risk before, they really don't know how to assess the risk now, and they're bleeding capital by the millions. Even well-capitalized companies. Here's an example of just a portion of the letter that the NBA has sent to a lot of the regulators. Margin calls on mortgage lenders reached staggering and unprecedented levels by the end of the week. For a significant number of lenders, many of which are well capitalized, these margin calls are eroding their working capital and threatening their ability to continue to operate. I mean, these are lenders, big national companies with tons of cash, and all of a sudden they're shutting down. Non-QM, that was the most rapidly rising segment of the mortgage industry. That all but disappeared in the matter of a week. We're starting to see tightening of the government loans and those kind of things. A week ago, I could have done an FHA loan with a 580 credit score. Best I can do right now is 660 credit score. That was all in the matter of a week. So the last part that kind of wrapped that part up, stimulus is sort of the cherry on top. Obviously, we need the stimulus. The government's trying to do everything they can to keep the economy afloat while people are trapped in their homes. But the stimulus, I mean, it was 1,400 pages or whatever. They didn't even know what was in it completely. And so there's a lot of unknowns. One of the big terms coming out is forbearance. So a whole lot of people are thinking, hey, I'm not going to have to make mortgage payments for a while. A lot of people don't understand what forbearance is. But forbearance creates more questions for servicers because servicers have to make payments on those loans, whether they collect payments or not. So if the government says, hey, you don't have to make your payment for 6 months without putting a backstop in for the servicers, there's more capital bleeding out of the system, more chaos. Governments are the worst because of which, or government loans because of which type of, how much of the payment they have to make, that kind of thing. So stimulus has just added to more confusion. Will it be fixed? Probably. A lot of damage has been done. There's chaos for a while. Any given lender, you might see wild swings in what they can and cannot do as this is happening so quickly. Good news is it's being addressed. NAR has been involved, Mortgage Bankers Association, a lot of our trade associations tied to our industry are raising the red flag to the Fed. Hey, you've got to stop. Here's what we really need to have. We need the Fed to stop buying mortgage-backed securities immediately. They slowed down last week, so for the last couple of days, so they're hearing the message. They haven't necessarily done it. We actually need rates to increase for the time being. It sounds weird for mortgage lenders to say that, but rates going up right now will help us. And then we need to clear out this massive pipeline that's working its way through the pig, if we go back to that analogy, so that the lenders can get the capital back to recoup, all that hedge money that's gone. It's going to take a month or two just to kind of get out of this, let the dust settle, and then they can kind of figure out where we're at. Until then, though, for the last month or so, I've been saying it's going to get worse before it gets better. That is obviously proving true, and there's still more of that, I think. The good news is it's not all dire for housing yet. And I do think the government's going to get involved this time. It's not like it was in 2008. The underlying health of the housing market was strong this time. So, a lot's going to depend on the pandemic and the timeline when we can get back to work. But that's sort of kind of the overview of what's going on. And it literally, the past 3-4 days has been the bulk of the chaos.
That is a lot.
Yeah.
And all of that made me think of like 1,000 questions that I want to ask you. But I guess the one that I'll start with first, and you kind of touched on it. So you said that the credit score limit has changed. Can you talk on that a little again and just tell us again what it needs to be now?
So I can't answer that question universally because it's going to vary from lender to lender, and it's going to vary more than normal. Especially on government program, really what the market's looking for right now is squeaky clean A-paper type things. They don't want to take risks because they all remember what happened a decade ago when they ran out of liquidity and that caused the problem. Well, that's where we're at, potentially where we're at now. So you're going to start seeing, I wouldn't be shocked. I'm not saying it's going to happen, but I wouldn't be shocked if before the next week or two, you might see a lot of lenders saying we don't want anything below 680. 640, 660 is going to be the norm right now. 620, you might still be able to get that in some conventional loans. Government's going to be tough, but obviously the days of doing 580 credit scores are gone for a while. So I guess to answer your question, the trend is moving toward mid to upper sixes.
Okay. And so if I have a buyer with a pre-qualification letter from like February, beginning of March, is that even worth anything?
It is not worth anything. It doesn't mean they're not pre-qualified anymore. It just means that you need to talk to your lender ASAP. And most lenders right now are doing triage on the loans that are in process. So a lot of them, it's happened so quick, they haven't had time to look at those that are prospects or pre-quals that have been around for 2 or 3, 4 months. So, the sooner they can talk with their lender, if you got someone shopping for a home, get back with your lender if that pre-qual is anything more than 2 weeks old. Because a lot of the people that were pre-qualified and we would have considered well-qualified are no longer well-qualified.
And again, I have so many questions, but the next one would be, so if we have a contract in place now, will the timelines for closing be affected from the lender side?
Yes, but that probably was already taking place. I've started telling realtors about 3 or 4 weeks ago to start doing 45-day contracts at a minimum. we weren't there yet, but some of the timelines are more coronavirus related. For instance, getting appraisers into homes. We've already had a couple where someone's sick, appraiser's not going to go in. The government's working on that. They're already giving us a lot of programs are now allowing drive-by appraisals if the appraiser can't get in home, that kind of thing, or exterior only appraisals. But those, when you have a problem like this, you got to come up with a solution that can slow things down. We got an email yesterday from that the IRS is done doing tax transcripts. They'll work around that, but it takes a little bit of time. And then just the glut of volume we're working through right now as an industry, probably on average triple the normal loan volume of what we would be going through and during a busy time. Well, there's a whole lot of ops folks working overtime right now. Title companies are just buried. Appraisers have more work than shake stick at. So is it going to slow things down? Absolutely. It was already slowing down. This is going to make it worse because now we have to work through, okay, they were qualified before, now they're not. Jumbo loans are a great example. Jumbo market is drying up rapidly. Everything's being looked at more closely. We've got to factor in, are people losing their jobs? We've got to we're being advised to be very diligent on, is this person's job affected by the coronavirus? Because a lot of people are being laid off by their companies so they can collect the unemployment benefits. And that's a good thing for them as opposed to sitting at home not getting a paycheck. But you're not probably going to close on a loan if you're on unemployment. So the answer is yes, but a lot of that damage had already been done.
And so and this is just a random question, will programs like the HDA or USDA be affected?
Yep. Some lenders have already stopped with VHDA temporarily. VHDA, for instance, that's a state program that's funded mostly by tax-exempt bonds. Well, the bond market's in chaos right now. We haven't stopped doing them, for instance, but the parameters have tightened up. So they're definitely going to be affected. All of your government programs, again, a lot having to do, without getting in the weeds, of how government loans are serviced differently than conventional. Those are probably taking it down the chin more than anything else. Rates have changed dramatically on the government loans as a result of that risk. And so, yeah, they're going to be affected. Are they going to stop? No, but if you've got a conventional loan, you got good credit, as long as you keep your job, you're probably going to be fine. If you've got a government loan, you're probably going to be fine if you're already in the system. If you're a really good borrower, you're probably still going to be fine, even if you haven't found that house yet. If you're on the outskirts, you might have to do a little more work. But governments will definitely be affected.
And I know everything's changing minute to minute, but for realtors and anyone else listening, we're going to have to do this together as a team to make all this work. But at the moment, how best can we help you guys do what you need to do to get our clients to where they want to be?
Just make sure clients understand what's going on. And we don't even know what the new normal is yet because we can't define normal. So I think the key is just clients being understanding that things are different. I think for most people, though, that's easy. We're sitting in our homes doing these interviews right now. So nothing's normal. But I think clients need to understand that that's going to be the case there. It's still a good outlook for housing at this point. 2020 should be a good year. It's not time to panic, but it's going to be crazy for a couple of months. And so I just helping the clients understand, if we're asking for paperwork, sometimes I'll get clients, I didn't know which of that stuff you needed. Well, if I asked for it, I need it. We're not asking for paper just for the fun of it. And we're going to ask things a little more carefully than we would before. We're going to get pushback on some things that we might not have gotten pushback on before. So they just need to be patient. And, we all make money the same way. We need homes to sell and loans to close. So, you know, if they work with us, they're going to have a much easier time. If they're fighting us, but they also need to understand that it's not just their lender. You know, it's not like, oh, well, these guys have, everybody's dealing with it. So be patient with them too. Programs are going to change. Now, does that mean that because one lender can't do something right now that another lender can't? No, but it means that a lot of lenders probably can't. And so that's the big thing. Just encourage them to get their paperwork in as quickly as possible, because everything's going to take a little longer to work through. Be patient, be forthcoming. You know, our job as the loan officer is to try and help them get their loan, to get what they want. So they need to look at us as their partner in crime, if you will, not their enemy. We're not an attorney trying to put them in jail. We're their friend trying to help them get money they need. So that would be the biggest thing.
Well, I'm officially overwhelmed.
You know.
But I think this is great. Is there anything else that you feel like you would like to add to all of this?
No, I feel like I've already dumped a lot of information out there, and I guess I just would reiterate it's not time to panic. It's time to be careful, pay attention. You know, I've been advising my employees, we got to double check, triple check things, be more diligent. Same thing with realtors. But it's not time to panic. And I guess I would just ask for patience. We're fielding phone calls all day long at this point, more than the normal. You know, Fed dropped rates. So anytime the Fed does that, the average consumer thinks right now that the mortgage rate ought to be 1% lower, or it should be 0, depending on, in both cases, it's wrong. They don't realize the Fed doesn't really do anything on the mortgage rate side. So if we're not returning a phone call right away, it's not because we're ignoring it. We're getting to them as fast as we can. You know, and then loan officers too, we're encouraging them. On our side, we need to communicate as proactively as we can, so the phone calls don't have to come in. So it's definitely a team effort. You pegged it right, but we'll get through this, and it'll be a good year. You know, the iBuyers are gone for the most part, and they were public enemy #1 for both of us. So hopefully they stay out of the picture, and we can have a healthy housing market instead of them. So, but it'll be a fun time.
It will be interesting.
Yeah.
Well, thank you for all of that information, and I'm sure all of this will change by later today.
Right.
But hopefully we can do another one of these maybe next week, or when the information has changed so much we need to. But thank you so much.
Thank you.
And I'm sure I'll see you and talk to you again.
All right, sounds good. We'll talk soon.
Okay.